Good morning. September 21, 2021 School Land Board meeting will now come to order. Pursuant to section 31.015 of the Texas Natural Resources Code, I'm chairing the meeting in the commissioner's absence as chief clerk of the General Land Office, as the commissioner is away on state business. Should the commissioner return prior to the conclusion of this meeting, I will relinquish the chair to him. September 21, 2021 meeting of the School Land Board is being held in person at 1700 North Congress Avenue and by video conference call as authorized under Texas Government Code section 551.125. Access to the meeting by members of the public was published in advance in the Texas Register in accordance with the Texas Open Meetings Act. Any member of the public who wishes to address the School Land Board on a matter within the authority should indicate so at the start of the meeting or during any public comment period. Just as a reminder, item number 2C7 was pulled from the docket prior to the meeting, and would say welcome to Mr. Burciaga. Good to have you here in person, and I appreciate staff putting this model together. Hybrid model looks like the way we're going to do it moving forward. So appreciate everyone's hard work in putting this together. First item on the agenda is item number 1, approval of the minutes from the August 24, 2021 School Land Board meeting. I will take a motion once members have had a chance to review and approve.
I will move to approve.
And looks like we have a motion to approve and second. That item is approved. Next item on the agenda is docket item number 2, approval of the consent agenda. And just as a reminder, item number 2C7 from that agenda was pulled.
Scott Rorman's here. Can you hear me?
We can.
Scott, I'm sorry, Scott, I'm afraid you need to turn on your camera because of the restrictions that were lifted. There you go. Thank you, sir. Sorry, Mr.
Got a motion to approve?
Motion to approve. Is there a second?
Second.
Motion is made, seconded, and carried unanimously to approve the consent agenda item with the removal of item number 2C7. Next item on the agenda is number 3, consideration and possible action to authorize the rebuilding of PC 1377.
Good morning, Amy Nunez with Coastal Field Operations. And on June 18th of this past summer, cabin permit 1377, which is located in Brazoria County in West Bay, was damaged in excess of 50% by a fire. The permit holder contacted staff and it was confirmed to report both the damage, and they're working on debris cleanup immediately following. What they think happened was an ember from a barbecue pit flew out. They were there that weekend that it happened, and then they think it got caught in a piece of bedding or something like that. So they were literally just leaving the cabin and it caught fire. So, they turned around, but it did do significant damage. This cabin is authorized under Chapter 33 of the Natural Resources Code, and 33.130 states that if a structure for which a permit is issued is severely damaged or destroyed by any means, no major repairs or rebuilding may be undertaken by the permit holder without approval of the board. The current permit is in the middle of its term. It expires on August 31st, 2023. And at this time, the permit holder is requesting to rebuild the structure as authorized in the current permit. They have no proposed changes, just a rebuild of what's authorized. At this time, staff's recommending the board to authorize the rebuilding of this cabin as provided in the permit in accordance with Chapter 33. Staff recommends all repairs be completed by July 25th, 2022, which would be approximately 1 year. June 18th, 2022, which would be a year following the incident. But we do request authorization to grant additional time to perform repairs as needed or as circumstances warrant.
Any questions from the board?
So no cost to the state, and they have to rebuild what was there before.
That is correct, yes.
I don't have any questions.
Motion to approve?
Second.
Motion is made, seconded, and carried unanimously. Thank you, Amy.
Thank you. Thanks.
Next item on the agenda is item number 4.
Mr. Chairman, members of the board, this is Jeff Gordon, GLO General Counsel. I've sent to you in advance or had sent to you in advance the PowerPoint for this, involving Senate Bill 1232, which creates the Texas Permanent School Fund Corporation. It's a pretty significant piece of legislation for those of you who've had a chance to read the PowerPoint. I'm going to go through some of the highlights in the PowerPoint and or through the PowerPoint of the bill, and then reserve time at the end to answer any questions you may have. It's a fairly complicated piece of legislation. Corey, if you go to the next slide, please. So during regular session of this past regular session, Senate Bill 1232 was enacted, signed by the governor, creating the Texas Permanent School Fund Corporation. It would combine the permanent school fund, the bifurcated management that we're familiar with between SBOE and SLB, combine that into one single fund and run by a new special purpose government corporation that's called the Texas PSF Corporation. According to the bill's authors, the idea was based on how the University of Texas and the A&M UTEMCO model operates, which, as some of you know, started managing PUF back in 1996. The corporation is going to consist of 9 members, 5 appointed by the SBOE. The presumption, frankly, there is that the 5 members of the SBOE's existing investment committee, which is a subcommittee underneath the larger SBOE. The presumption is that those 5 members will become appointed by SBOE to this board, although it's not guaranteed, but I think that's kind of the presumption there. Then the other members, the land commissioner will always be a member. The land commissioner shall appoint a member with background and expertise in investments. And then the governor will appoint 2 other members also with background and expertise in investments. The bill has a couple different effective dates. The first effective date is September 1st of this year. There's a later effective date where the actual transfer of assets and investments, that doesn't occur actually no sooner than December 31st of 2022. So there's a fairly significant time gap between some of the initial actions that need to be taken versus the actual transfer of these assets. But there's a lot of work to be done, as you'll see in the meantime. SBOE is authorized to create the corporation. It is approving the initial certificate of formation. They actually had the small subcommittee, the investment subcommittee had their first meeting a few weeks ago, and I watched that online, and they presented the articles of incorporation, and they expect to vote on those. The draft is out. They expect to vote on those in November 2021 at the next SBOE meeting. Then there will need to be, once the corporation is formed, the board members will need to be appointed by either the SBOE commissioner or the governor. Then the board itself, the 9 members, will adopt bylaws, which have to be approved by SBOE to become effective. The board will, of course, elect officers, president, vice president, things like that, secretary. It will need to establish an ethics policy, similar, I assume, to what we have here and what SBOE has. The board will need to determine the process to and actually employ a CEO. And eventually it will be required by statute to establish a minimum distribution rate with respect to the distributions that it will end up making to the ASF, the Available School Fund. And there are things that it may consider, such as the needs of current and future students, as well as distributions to the ASF that are going to be made by SBOE. And I can expound on that later because there is still going to be the opportunity for distributions to be made by SBOE, by the SLB, albeit probably significantly smaller, and then, of course, by the new corporation. No sooner than December 31st of 2022, on a date mutually agreed to by the different entities, that's really where the authority is going to be transferred. So by that date, all power, duties, functions, et cetera, programs, activities of SBOE and TEA relating to the management and investment of PSF is going to be transferred to the corporation. Similarly, all powers, duties, and functions of the SLB relating to assets, certain defined assets or investments of PSF shall transfer the corporation. And what that is shorthand version is that's really the private equity investments, the things that Rusty's shop does, the investment management group. The GLO and the SLB will still continue to manage and hold the real estate, the oil and gas revenues, and the oil and gas interests. And it will still be allowed to invest in what are defined as real estate investment holdings, which is, for instance, the Johnson Development Partnerships that we have done. It'll still be managing those assets, but it no longer will have authority to make those investments that our investment management group led by Rusty Martin does. That authority will be transferred to the new corporation.
So it won't be governed by this board.
That is correct. The board still will have significant authority over the assets, but it will not be allowed to nor be involved in those private equity type investments. Also effective that date, all the employees of PSF division of TEA and our investment management division shall become employees of this corporation. So those shops at each of those agencies will, one day they'll be employee of TEA or GLO, and the next they'll be an employee of this corporation. And it is a quasi-governmental corporation, so their benefits, their retirement packages, any incentive programs they have, those will all transfer as well. So they're not going to be harmed from that perspective, from an HR perspective. Then there is a series of significant deadlines and procedures laid out in the bill for commencing a really lengthy process of transferring those assets and investments under the control of the corporation, except for the land and the mineral royalty interests. So that's going to require exchange of documents, a lot of legal work involved in transferring these investments, these equity stakes to this new corporation. There is provisions where if it is perhaps either not the general partner of the investment fund doesn't permit it, or there's some concerns about that, or it would not be a good investment wise to do so, then there is provisions that will allow SLB or SBOE to retain those. I think the general idea is that those are all going to be transferred to the new corporation. And then effective also December 3rd, 2022, all the revenues that we at the GLO and SLB receive from the mineral royalty interest will be transferred each month to the corporation, except less any amount specified by appropriation to be retained. So right now we are allowed by Legislative Appropriations Act to use the PSF assets to maintain retain the PSF revenues to improve and protect and manage the assets. It's our assumption that because we will still be holding vast land and mineral interests, that we will still be allowed to use those PSF revenues, not transfer those to the new corporation, but use those to manage so that the things are, the leasing is still being done and the land is being protected and things like that, as well as the opportunity for, these direct real estate holdings. But that'll be something that'll have to go through future Appropriations Act. And then finally, the General Appropriations Act for this year required TEA and GLO to submit a plan to the LBB describing the steps that we are going to implement. We all are going to implement to really effectuate the statute. It includes a description of the appropriated funds, FTEs, and a lot of logistical things. We got together with TEA before the deadline of September 1st and decided to submit a joint plan, which we did. I'm happy to share that with you all if you'd like to see a copy of it. LBB has 45 days to approve it, or they can disapprove the plan. If they are silent, then that constitutes approval. That plan generally talks about such things as you can imagine, there's a lot of logistical steps here. There's office space for the employees because you're combining different groups. There's FTEs, there's HR. Who do you hire? HR. IT is a huge issue, making sure that all the IT is taken care of. And so a lot of that plan involves kind of the process for not only creating the corporation, but how do we get these things in place logistically for this new corporation to be up and running and not having to stop and managing these, significant billions of dollars worth of investments at the time. So again, I'm happy to share that with you. It is a lengthy bill. I read it. I wrote some, or helped write some of it, but I'm happy to answer any questions that the board may have.
So Jeff, like Rusty's presentation of today, that will, when this is implemented, that will no longer happen. He will not be reporting results to us.
Correct.
Okay.
There are some things that will be repealed effective December 31st, such as we no longer will have a annual joint meeting with the SBOE. The liquid fund account that they created last session will go away. That money, there will no longer be a need. So it will go to this new corporation to be held, or at least be managed. There are certain other reporting requirements that will go away as well.
So Rusty, we won't see you anymore, huh?
Rusty will be here for a little while longer, so I don't want to say goodbye today.
I don't know that you won't see me anymore. I'll still be around.
Good.
And certainly I'll be around till the end of next year. Although myself and my staff and a lot of other people are going to be very busy trying to get this thing stood up and put together in the right way. It's very complex, as you might assume, but I think we're already well on the way to sort of figuring out what it's going to look like. So at this point, I mean, the real critical things are standing the committee up and the committee hiring the CEO to start putting some of the logistical things into place so they could start putting some meat on the bones for the overall framework. But you're not rid of me yet, Gil.
Good.
One question I had, and I know you touched on it in the summary. I know one of the kind of the alleged claims for creating this was to get more money into the available school fund, but the statute itself, the language does not require this new corporation to set a floor for a minimum distribution.
It requires them to set a distribution rate.
Okay,
It
so it
is-
will be
yes.
incumbent on this new corporation
That
to
is correct.
decide what that rate is. The
Yeah.
statute itself doesn't require a minimum.
It just doesn't set a minimum. Now,
Okay.
I don't want to get too far into the weeds, but if you all recall, the Texas Constitution Article 5 talks about the distributions that are made to out of the PSF. SBOE has a section in 5A, which talks about it's that 6% number that it can exceed based on various calculations. And then in 5G, there's a provision that puts that cap at 600 million a year. We had that, the commissioner supported the raising that from 300 million to 600 million a few years ago. This corporation will be covered by that cap of 600 million per year, unless of course the citizens want to raise that. But right now that corporation will be subject to that cap in 5G of 600 million a year. But the idea was that it would create a minimum distribution rate by rule that would be in place that basically I think the legislature could rely upon to know what that minimum distribution would be.
Okay.
Jeff, could I weigh in? First,
Yeah.
I just want to say that this is a great thing for kids. I know this was a heavy lift for staff, and I just want to thank everyone who was involved in helping shape this legislation to be the best possible. I know we've all struggled with the cash drag associated with the liquid account, and there's been steps to make sure that that return was as high as possible, but obviously given its requirement to be incredibly liquid, it limited the amount it could be and what it could be invested in. And I think structurally, this is a great solution. I just want to commend staff for putting their shoulder behind this and getting this legislation up and well informed. So thank you for all the work that went into getting this the best legislation possible.
Well said.
And Mr. Chairman, this was not a voting item. It was just for discussion purposes.
Thank you. Any other questions, comments from the board on this item? Hearing none, we that is a non-voting item. We'll move on to item number 5, quarterly investment report.
Thank you, Mr. Chairman. Members, for the record, my name is Rusty Martin, Chief Investment Officer. This is a non-action item. I'm pleased to present you with a quarterly investment report of the TexGlo Permanent School Fund Investment Portfolio for the period January 1st through March 31st of 2021. As you're aware, the calculations and statistical data that are presented in the report are prepared by State Street Bank and its Private Edge Group. They are the custodial accounting and performance measurement agents for the portfolio. I'm going to present a brief executive summary that covers macroeconomic conditions in the U.S. for the period. Also, I'll discuss briefly energy markets and the real estate markets, and then we'll move into the numbers regarding performance itself. First quarter, U.S. GDP increased at an annual rate of 6.4%. That followed an increase of 4.3% for the fourth quarter of last year. That increase reflected the continued economic recovery, reopening of business establishments, and continued government response related to COVID-19 pandemic. In addition, government assistance payments, such as direct economic impact payments, expanded unemployment benefits, and Paycheck Protection Program loans were distributed to households and businesses through the Coronavirus Response and Relief Supplemental Appropriations Act and the American Rescue Plan Act during the quarter. Unemployment ended the quarter at 6.0%. That was down from 6.7% at the end of last year, again, reflecting continuing efforts to mitigate the economic impact of the pandemic. As far as the Fed is concerned, as you're aware, in March of 2020, they decreased target Fed funds rate from a range of 1.5% to 1.75%, all the way down to a target range of 0 to 1.25%. And they reiterated at their March meeting this year that they're going to maintain this target rate range until labor market conditions have reached levels consistent with their assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, they also reaffirmed the continuation of their balance sheet normalization program that they launched in 2017. And as you're aware, that program centers around the reinvestment of principal payments from its holdings in agency debt and agency mortgage-backed securities, as well as rolling over at auction any maturing Treasury securities. They also stated they would continue monitoring the implications of incoming information for the economic outlook, including public health information, inflation pressures, international developments, and they would use their tools as appropriate to support the economy. In addition, the FOMC indicated that it would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The Fed is having a meeting tomorrow. A lot of people are watching that meeting. There's been a lot of talk recently about the possibility that the Fed would begin tapering back some of its support for the economy. There will be a lot of eyes on that meeting tomorrow. Tomorrow could be a big day in markets, depending on what comes out of that meeting. As far as the commercial real estate market is concerned, the NACREF Property Index, or NPI, returned 1.72% for the first quarter. Its trailing one-year return was 2.63%. The increase in returns were attributable to improved performance across all property types, particularly the continuing strong performance of industrial warehouse properties. While it appears that the worst is over in terms of the effects of COVID-19 on U.S. real estate returns, the market is still in a transitional phase as it adjusts to the way that people now shop and expected to work in the future. The first quarter gross returns for each of the individual sectors of NPI were hotel was down 1.61%, retail was down 0.45%, apartment was up 1.69%, office was up just under 1% at 0.99%, and industrial was up a whopping 4.72% for the quarter. That performance from industrial was due, of course, to strong performance in the industrial warehouse space. And that sector has led all property types in performance since first quarter of 2016, so 5 years now. Moving to the energy markets, starting with oil and WTI spot crude prices averaged about 58.09 a barrel during the quarter, ended the quarter at 59.19, which was a 22% increase from the fourth quarter 2020 ending price of 48.35 a barrel. This increase was driven primarily by supply cuts, underinvestment in the sector, and recovering worldwide demand. At the end of the quarter, OPEC Plus was curtailing about 8 million barrels per day of production to offset lost demand related to the COVID pandemic. Global oil demand bottomed out in April of 2020 at about 80 million barrels per day, but has since recovered to about 95% of the pre-COVID high, which was around 100 million barrels per day. On April 1st of this year, OPEC Plus reached a consensus agreement to increase production gradually, beginning in May this year. Those increases are expected to add more than 2 million barrels per day to global supplies. They also stated they would continue to monitor market demand and would take any actions necessary to maintain a reasonable pace of inventory drawdown. Turning to natural gas, Henry Hub prices averaged $3.50 per million BTUs during the quarter, but ended the quarter at $2.52 per million BTUs. That was a 7% increase from the fourth quarter 2020 ending price of $2.36 per million BTUs. Market indicators for natural gas remain bullish in the near to medium terms, and most analysts expect relatively strong prices for the remainder of this year. That bullish sentiment is driven primarily by new LNG projects coming on stream in the next 5 years, increased industrial and power consumption estimates, decline rates, and lack of capital investment in the sector. Consensus expects 2021 U.S. natural gas production to decline by about 6% year over year, and most analysts expect gas prices will hover in the $3 to $3.50 per million BTU range for most of the year. Turning now to the performance measurement statistics, begin looking at page 2 of the report. The total net asset value at the end of the quarter was $4.872 billion. The portfolio was responsible for 92% of that, $4.443 billion. Cash equivalent investments on hand was $399 million, about 8%. Looking at the returns on the portfolio, starting with the gross returns without cash, portfolio had an excellent quarter, a very strong quarter, up 4.95% versus 2.45% on the benchmark. So outperformance at 250 basis points for the quarter. The real estate sector of the portfolio was up 3.52%. Infrastructure was up 2.04%. And energy was up a very strong 10% for the quarter. Looking at 1 year, 3 year, 5 year, and 10-year returns, again, very good numbers for the portfolio. 1 year gross return 11.17% versus 4.98 on the benchmark, outperformance of slightly over 1,000 basis points there. The 1 year sector returns, all very strong. Energy up 16.28%. Infrastructure up 11.65%, real estate a healthy 5.52%. Looking at 3 year returns, that's the only sector, only part of the range where we're slightly below the benchmark. And of course, that's because energy was hit so hard in the past couple of years. 3 year return was 3.31 on the portfolio versus 5.36 on the benchmark, so outperformed by the benchmark there by about 200 basis points. Looking at the 5 and 10 year returns, very strong, 8.97% on the portfolio versus 5.86 on the benchmark, so 311 basis points outperformance there. And on the 10 year, 12.25% on the portfolio versus 8.04 on the benchmark, outperformance of 421 basis points there. As you're aware, The policy return is the 5-year net of fees return on the portfolio. Also good news there, the portfolio net return for the 5-year period was 6.87%. The benchmark's return was 3.50%. So on a policy return basis, portfolio outperformed the benchmark on a net basis by 337 basis points. At the end of the quarter, about 27%, which is a little over 2.2 billion of our total existing capital commitments remained unfunded. 26% of real estate, 28% of infrastructure, and 28% of energy. As far as new investments during the quarter, there were no new capital commitments by the board during the first quarter. However, following the first quarter, as detailed on page 15 of the report and subsequent events, there were 2 new fund investments, one to USAA Housing Platform Fund and one to West Street Infrastructure Partners 4 LP. There was 1 new co-investment, that was Capital Co-Investment 17, which was an upstream, proposed upstream co-investment alongside Intervest. That deal did not make. There also was 1 expansion of an existing fund investment that was a $100 million expansion of an existing $200 million commitment to Line Industrial Trust.
Rusty, what page are you on?
That's page 15. Subsequent events. Turning to the allocations on pages 7 and 8, on a purely invested or net asset value basis, the portfolio allocation of real estate at the end of the quarter was 28% versus the target of 33%. Infrastructure was at 39% versus a target of 32%, and energy was at 33% versus a target of 35%. Those allocations reflected the extreme levels of volatility in the energy markets at the time. And as you know, over time, these allocations will become more aligned with our policy allocation targets as the board makes new commitments in the various sectors and as more of the existing unfunded capital commitments are actually funded. Just a reminder, in April of this year, you did adopt new allocation targets for the portfolio. Real estate was left unchanged at 33%. However, energy was reduced to 31% target versus 35% before that. And infrastructure was increased from 32% to 36%. Currently, the allocation, if you look at page 8, you'll see the allocations based on net asset value plus unfunded commitments, which is a slightly different picture. And in that slide, you'll see that real estate was at 27%, infrastructure was at 38%, and energy was at 35%. Turning to the geographic diversification, pages 11 to 12, the allocation to the U.S. is currently 95% of the portfolio compared to a target of 85%. International allocations 5% compared to a target of 15%. But again, in April of this year, you changed those allocation targets for geography to 90% U.S. and 10% international. Looking at portfolio investment manager exposure, which is on page 13 to 14 of the report. On a purely invested basis, we continue to be well diversified across a platform of 25 different investment managers. Our policy statement limits the exposure to any one investment manager to no more than 20% of the total portfolio. At the end of the quarter, we're well within that range. The top 5 highest exposures are InCap Energy at 12.02%, USAA at 9.34%, Macquarie Infrastructure Partners at 8.13%, InCap Flat Rock Midstream at 7.58%, and Clarion, which is the sponsor of Line Industrial Trust, at 5.71%. The co-investment vehicles are grouped by manager and presented separately. At the end of the quarter, the exposures were in-cap Flat Rock Midstream at 8%, followed by First Reserve at 5.04% and BlackRock at 4.54%. That concludes my presentation. This is a non-voting item, but I'm happy to answer any questions you may have. And again, a very strong quarter for the portfolio.
Thank you, Rusty. Any questions, comments from the board?
I have a question. I'm just looking at the document, Rusty. First of all, thank you for a great report and a great quarter.
Thank you.
Would you mind answering just on page, I know this is obvious and for whatever reason, I'm just missing it. On page 8, when you outline the private equity portfolio with a net asset value of 4.4 billion at the bottom there, and we have unfunded commitments of about 2.2 billion. Can you remind me how that 2.2 billion compares to what's in the liquid account right now?
So the liquid account is roughly around 4 billion right now.
Okay. And the mechanism for what is in the liquid account versus our unfunded commitments, how do you think about that? In other words, what's the right ratio of liquid account to have versus unfunded commitments?
Well, of course, I don't have a perfectly predictable crystal ball.
Mm-hmm.
A lot of it depends. There's a lot of factors involved. First of all, there's a lot of revenue that comes in off oil and gas,
Mm-hmm.
the minerals that we have.
Mm-hmm.
The money that goes out depends upon the pace with which the investment managers call the money, also with the pace upon which we make new capital commitments, and then how those commitments actually go down, funnel down into the call mechanism. As it has turned out, if you look back since the liquid fund was created, we basically have, I think we've only called money back one time. So we effectively have been able to fund all of the capital calls that have occurred on the existing funded commitments from cash flow generated by not only the minerals royalties, but also by the cash flows from distributions on the investments themselves. So if you look at it and make the assumption that everything would continue the way that it has, you could make the argument that we wouldn't have to recall any of that money from the liquid fund. But of course, I can't with any certainty make that kind of a prediction going forward, but that's the way it has played out so far.
Yeah, I guess what I'm asking, Rusty, and the board, frankly, is what is the right number to keep in the liquid account? Because as you know, the liquid account has to stay fairly liquid by definition, which limits the amount of the types of investments it can be invested in. And if in recent years, we have only had to call back a small portion of it because we've been able to fund our capital commitments, both from distributions from the private equity fund, as well as the earnings off the real estate and minerals, what's the right number to ask the SBOE to continue to manage in that kind of limiting, constraining, liquid way?
I'm not sure that's the way to look at it, because I think the question is not how much, but what kind of allocation should they have in that fund? How should they be allocated investments in that fund? Because they have recently increased the amount of equity they're investing that money in, and they're going to increase it some more based on this sort of history that I was just describing to you. So I don't think it's an amount question, because that fund's going to go away anyway at the end of next year. It's how they invest it, and they've been slowly moving towards a diversification that looks sort of like their overall portfolio. Does that make sense?
It does, and I think obviously they have a ways to go, and they've reallocated at a measured pace. I still think it is I still think that portfolio is more conservative in its investment than the overall SBOE portfolio because of
It is,
the liquid nature.
it is, but it's becoming less conservative as they move forward.
Yeah. And then let me ask you one other question, then I'll stop. Page 10, what's the difference between the net market value of 5.8 billion and the 4.4 billion net asset value on page 8? What drives that difference?
A net market value is a different calculation. Net asset value involves the accumulation of incentive fees to the promote, management fees, all of those things. Net market value does not. It's a different calculation.
So the net market value is at the gross level prior to economics to the manager.
Yes.
Okay. I have no further questions. Thank you.
Thank you.
Any other questions, comments from the board? Hearing none. This is a non-voting item. Thank you, Rusty. Excellent work as always.
Thank you.
No further business before the school land board. The meeting is adjourned.